Good afternoon. Welcome to the TheoTrade afternoon video. I am Blake Young. Today is September 5th, 2024, and today we're going to talk about consumer finances show weakness in jobs. Now, we could take it the other way and say weakness in jobs is showing weakness in consumer finance. So if we're going through, we're really comparing the availability of jobs, the growth in jobs, and the ability to spend. Consumer discretionary spending we talked about last week compared to utilities. That's why I have the chart pulled up here. And as we're looking at this, we can see that utilities have pushed higher and higher and higher. That's the red and green through here. And we're watching this from the trend perspective. The fact is we're above the average, and that would be betting on utilities and against consumer discretionary as long as we're over this level. And consumer discretionary has retested the previous highs and failed to break through, while utilities have continued to move higher. What that tells me is that consumer discretionary spending is struggling. And we're based all of our spending now off of needs like utilities, consumer staples, and healthcare, and not on things we want. Even though we may want them, we're not spending money on there. So what does that mean? We can look at a couple of things. We have the highest amount of credit card debt in history, and we have the highest amount of default in years. Let's go take a closer look at consumer discretionary spending and the credit card companies or the finance companies that pay into that spending behavior. And to make that comparison, we're going to go to the market watch. You can see a lot of red in financials, a lot of red in healthcare, a lot of red in consumer staples today, a lot of red in industrials. Basically everything was negative except for consumer discretionary and communications today. And communications was pretty low, and consumer discretionary was primarily driven because of Tesla. Everything else in consumer discretionary is red except for Amazon and Tesla. So Amazon and Tesla held up this entire sector, and Tesla, which makes up about 12% of it, was 4.4%. So about 0.5% of that 1% rally in consumer discretionary today was Tesla alone. And as we're looking at there again, lots of red in consumer discretionary. So I want to look specifically at finances or financials and go into here, and we're going to look even closer at consumer finance companies like CapitalOne Financial and Ally. Now, Ally is not listed here, but we're going to look at CapitalOne Financial. We'll look primarily at Ally and CapitalOne Financial. Starting out with Ally, Ally does a lot of loans on credit cards and really on cars that people want to borrow, and it's not considered a prime lender necessarily for all lending. Ally does do prime lending, but also does secondary lending in the automobile market. So if we're spending less money on discretionary, less money on renewing or getting a newer car, less money in this area, and if we see defaults, repossessions, and highest credit card rates ever, then we should see a correlation between Ally and consumer discretionary. Down here I have the correlation study. If we look at this, we're going to focus not on 1 and -5. It tells you that we need to look at 1 and -1. That is our correlation range. And so if we're looking at that range, you can see that we're rarely inversely correlated. We are always above that 0 for the most part. And if we look at that, and that's day to day, and we see all the way back that the whole year we have very few times that the correlation is not there between Ally and consumer discretionary spending. And I would bet you that that primarily has to do with things like Tesla, that's Tesla sold off or Tesla rallied and broke things out of this correlation. But overall, we maintain a very, very high correlation. The same is true with CapitalOne Financial. We can look at CapitalOne Financial compared to this consumer discretionary spending. And again, rise, fall, back and forth. Look at the correlation. The correlation, again, exists between that 1 and -1, where the majority of the time we see in the last year, the correlation between CapitalOne Financial and CapitalOne Financial and discretionary spending is very high. If we look back at longer time periods, say like a 3-year, you can see this is a week-to-week comparison. And if we extend that backwards, and we'll just go back 3 years, then you can see the correlation is very high, except for right after the pandemic lockdowns and recovery. There was a disconnect through here, but overall it's still fairly close. They're still matching each other, CapitalOne versus consumer discretionary, rising and falling together, pivoting at the same key points. And right now, from the weekly perspective, you can see that The purple, which is consumer discretionary, is up and flat for the week, while Capital One Financial is down for the week and reversing. This is a clear reversal, gap down, close down for the week. For me, Capital One Financial weekly view is bearish. Consumer discretionary is flat and only flat because Tesla is up. Ally is going to show something similar for the week. If we look at the week, you can see in the background here, I'll move it up a little bit higher. This is clearly a reversal. It's a reversal pattern, higher highs, higher lows to lower highs, lower lows from the week to week pattern. So Ally, Capital One Financial is showing that we have weakness in here despite the fact that consumer discretionary is netted out flat for the week. That is almost exclusively due to Tesla. And if we look at the daily candles on Ally and Capital One Financial, not only did we create a widening pattern that clears out buyers and sellers, we clearly rolled over, clearly made a lower high, clearly broke through that lower high, lower low. And I would expect that Ally is going to go back and test 39.50. Capital One Financial has rolled over, clearly made a lower high after the same type of expansion, and its gap takes us all the way back maybe to 135, if not all the way down to 130. So we're looking at this possibly an 8 to 10% drop in Ally and Capital One Financial. And this is going to fly in the face of the rate cut expectations because the market is saying we expect a rate cut, so therefore we expect equities to go higher. We keep trying to price in 1 rate cut, 2 rate cuts, 5 rate cuts by the end of the year, and that should theoretically make money cheaper, the dollar weaker, and push equities higher. But if we are seeing lower employment, if we're seeing less money to spend, and we're seeing record high debt in consumers, then falling jobs, yes, it may trigger lower rates, but that does not mean more spending from the consumer if they do not have any money, or if their credit cards are maxed out, or if they're flat out in default. So ADP today came in at a negative, or 99,000, which is lower than expected by nearly 30-40%. It was revised lower in the previous. So this ADP is an early indication of what we expect to see come out tomorrow, and tomorrow's non-farm payroll. And if we look at the revisions, you can see we revised lower, 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 and we still aren't accounting for the fact that we expect, or we have revised nearly 1 million jobs out of the market. So these revisions and the adjustments, we're seeing that the job information is getting worse and worse and worse. We are creating lower highs, lower lows, lower highs, lower lows, and we're dangerously close to turning negative on the ADP non-farm payroll. It used to be that non-farm payroll from ADP was actually better than the government report because it was done based off actual paychecks cut, not just a survey. But they are following closer to the Bureau of Labor and Statistics now, so we will go with saying that it's just an early glimpse at what may come out in non-farm payroll Friday. Now, we're going to talk about that in more detail in tomorrow morning's live class, but I keep seeing that more and more information is pointing to less and less employed, less jobs available, less money to spend, inflation running faster than faster than payroll increase, and this is not a good sign for spending. Even if you think the lower interest rates are going to help the small cap and the tech stocks, it does not mean that it's going to really translate to more spending from consumers. And that number from ADP is our first glimpse into what we expect to see tomorrow. Now, the expectations in the analyst predictions, you can see that we're expecting better average hourly earnings, we're expecting better employment rates, and we're expecting better unemployment rate, meaning a falling unemployment rate. But the fact that we missed today by 45,000, that's 33% miss. Are we going to miss the 33% here? Are we going to see this closer to 100,000? Are we going to revise last month down again? And if we do, anything below about 200 is considered in the margin of error of no growth. We actually could be negative as it sits. That survey has such a large margin of error, anything below 200 is questionable. Certainly below 100 is probable that the margin of error is putting us into the negative as we watch this trend decline as far as employment is concerned. Which means that if I'm still looking at Capital One Financial and Ally, their primary lending, yes, is to credit cards, but we also have a large contingency of automotive vehicle loans. And so the loans that we're getting for cars is declining as well. Now, if we're getting less cars loans from Capital One Financial and Ally, are we also going to see less cars sold through companies like Carvana? Now, Carvana reached this previous high. We've rolled over from that previous high, and we're about halfway through the run-up. If we finish this pullback, I'm looking about 120, but I would like to see a little bit of a bounce in a lower high because we just went to expansion. We don't have the lower high like we do in Capital One Financial and Ally, but Carvana does look like it could be setting up for the next leg down. And CarMax has already rolled over at equal highs, not quite the same expansion. And so I'm looking for CarMax to fall to 80 and probably back down to 73. So I've got another 10% drop in CarMax, Carvana, Ally, and Capital One Financial. That's going to do it for me today. Join us tomorrow morning. We'll get more detail as far as even the setups on these particular stocks, as well as the discussion of what's going on in volatility and in non-farm payroll or the jobs data. And otherwise, we'll see you in the morning. Have a great night.